everyone. This course is being delivered on behalf of SNB Experts, the course administrator for this financial series. Welcome back to Module 10, where we will be mastering debt and financing structures in depth. In this 10-minute session, we will explore everything from term loans to complex capital structure modeling. Module 10 focusing on technical debt instruments and their impact on capital structure. Let's start with our learning objectives. This module is designed for complete mastery of key financing skills. We will cover term loan modeling, amortization schedules, and testing financial covenants. Additionally, we will dive into equity raises, dilution analysis, and hybrid convertible instruments. Section 10.1, Term Loans. A term loan provides a specific amount with a set repayment schedule from a bank. Short-term loans, with a maturity under 1 year, are primarily used for financing working capital needs. Intermediate loans span 1 to 5 years and are typically used for equipment or business expansion. Long-term loans are used for major capital expenditures and real estate, spanning 5 to 25 years. It is important to understand how these loan types fit into your overall capital stack and cash flow requirements. Next, we will focus on the seniority of debt, specifically looking at senior versus subordinated sources. Let's dive back into the slides to see how these differences impact the lender's risk and the company's cost of capital. Senior debt is the primary financing source and is usually secured by company assets, making it lower risk for the lender. Subordinated or mezzanine debt sits lower in the hierarchy and carries a higher interest rate for the increased risk. Now let's calculate periodic payments using a $10 million 5-year term loan at 8% interest. Using Excel's PMT function, we calculate a monthly payment of $202,764. The payment is split into interest and principal. In month 1, interest accounts for over $66,000. The principal portion of $136,000 reduces the ending balance of your loan. Moving to 10.2, grace periods. These windows allow borrowers to defer principal payments to preserve cash. Interest only is the most common grace period, where principal is deferred but periodic interest is still required. Grace periods can be powerful tools for startups or projects with delayed initial cash inflows. However, you must model the impact of capitalized interest, where unpaid interest is added to the balance. Let's look at a mathematical example of how capitalized interest compounding affects the total debt. On this $5 million loan, year 1 interest of $400,000 is added back to the principal. By year 2, interest is calculated on the new $5.4 million balance, compounding your liability. Section 10.3, Amortization Schedules. This is how debt is systematically paid off through regular installments. Straight-line amortization features equal principal payments, causing total interest and payments to decline over time. The equal payment method, or annuity, maintains a constant total payment, common in consumer mortgages. Balloon payments involve small periodic payments followed by a very large final payment at the loan's maturity. For a $1 million loan, straight-line principal is $200,000 every year for 5 years. Interest drops from $60,000 to $48,000 in the second year as the balance reduces. Monitoring these schedules is a daily task for financial analysts to ensure liquidity and debt compliance. Speaking of compliance, we must look at the covenants that lenders put in place to protect their capital. Let's examine Section 10.4 and the key financial ratios you'll need to track in your models. Financial covenants are health checks. Violations can trigger defaults or immediate interest rate increases. The leverage ratio, or total debt over EBITDA, measures your company's ability to handle its debt load. Interest coverage ensures your earnings are sufficient to pay your interest obligations at least 3 times over. The debt service coverage ratio, or DSCR, compares EBITDA to total periodic debt payments. It calculates whether your cash flow is enough to cover both interest and the principal portion of your debt. In our example, $5 million in EBITDA covers $2.8 million in service, giving a DSCR of 1.79. With a covenant threshold of 1.25, this company safely passes its periodic compliance test. Section 10.5, Equity Raises. We now move from debt to equity across various corporate stages. Equity is a different beast than debt. Instead of repayment, you are selling pieces of ownership in the firm. This brings us to the concept of dilution, where existing owners see their percentage stake decrease. Let's look at the different types of investors you'll encounter as your company grows and scales. Early stages involve seed rounds with angels and early VCs, typically for pre-revenue or initial product firms. Series A, B, and C rounds follow as the company hits growth stages, requiring larger institutional capital. Mature companies may reach an IPO or initial public offering to raise capital from public market investors. Dilution is the mathematical reality of issuing new shares. It directly impacts your existing ownership percentage. Post-money valuation is the sum of your pre-money value and the new capital raised from investors. Raising $5 million on a $15 million pre-money value means the new investor will own 25%. The original owners are diluted to 75% ownership. This calculation is vital for every cap table. Section 10.6, Dividend Policies. This is how profitable companies distribute cash back to their shareholders. Dividends are a key component of total shareholder return, but the policy must be sustainable for the firm. A company must balance returning cash today with reinvesting in future growth opportunities. Let's look at the different ways companies structure these regular payouts to their equity holders. A payout ratio policy links dividends to a fixed percentage of net income, varying with company performance. Residual policies pay dividends only after all profitable investment opportunities have been fully funded. With a 30% payout policy, a $10 million net income results in a $3 million dividend. If the company records a loss, as in 2026, the dividend payment correctly drops to zero to preserve liquidity. Section 10.7, Convertible Instruments. These hybrid securities start as debt but can convert into equity. The valuation cap is critical, setting the maximum price at which the debt converts into ownership shares. Discounts, typically 15 to 25%, reward early debt investors for taking on initial risk. Conversion involves calculating the total converting amount, including principal and any accrued interest. Modeling these hybrid instruments requires a step-by-step approach to capture all the relevant terms. You must be precise in your Excel formulas to ensure the cap and discount are applied correctly. Let's finish by looking at the key Excel functions that will make your debt modeling more efficient. Compare the cap price to the discounted round price and always use the lower of the two for conversion. Divide your total converting amount by that price to determine the final number of shares issued. Master Excel functions like PMT, IPMT, and PPMT to automate your debt and principal schedules. Build a clear covenant dashboard with conditional formatting to monitor pass and fail status in real time. Follow best practices. Link your schedules to the three-statement model and test under multiple scenarios. In summary, we have mastered term loans, amortization, covenants, equity raises, and hybrid instruments. You are now prepared to model complex capital structures. Our next module will focus on valuation techniques. Thank you for following along with this advanced series on behalf of SNB experts. I hope you found this deep dive into financing structures helpful for your financial modeling journey. On behalf of SNB experts, thank you for following. Please remember to subscribe to our YouTube channel. Good luck with your modeling. I will see you in the next module soon. Goodbye for now.